Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com wraps up the major markets for the week. We ask if the run for so-called safe havens is over. Editor of the popular blog Juggling Dynamite, Danielle Park, tells us Warren Buffett hasn't been all that accurate predicting winning stocks for a year and a half. She also comments on how unsustainable housing prices have been. Ed Steer from Ed Steer Gold and Silver digs into the precious metal market. He feels gold and silver are on their way to a long-term positive run. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Ray and Aven Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABN.V. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always good to be with you, Jim.
Ross, how would you sum up this month? We did see some days where the Dow looked like it was in critical shape.
Oh, yeah. I mean, you were getting, we started off the month just with like 4 or 5 tremendous days on the downside. I think we were on the verge of, one of the worst stretches that we'd seen in years. Got that nice capitulation low back on the 5th of August. And since then, it's just been a massive trading range. Tested the bottom of it twice, the top end of it the third time right at the end of the month. And this kind of chatter is what we talked about after that first capitulation, that when you've been in an uptrend and you get these hard breaks, they have to do a consolidation phase forget about the day-to-day news, but the overall, news, the underlying bias, catches up with the market. Now, at this point, it looks as though, from our perspective, that chatter is pretty much over. We would expect to see the market rally up and test the highs that we had during the summer. Probability is that it fails from there, but we'll take this a step at a time. One of the good positives that's in here for supporting the market, other than the fact that you've got like put-call ratios at extremes, suggesting that people are buying a lot of protection and more than they probably need. But the yield on the S&P is now just short of 2%. It's 1.92%. And when you compare that to what you can get in the government bond market, a 20-year bond is only getting 178. When you get down to a 2-year, you're down to 153. So everything on the government curve in terms of the rates is lower than when you can get in the S&P. And we've had like 8 examples of this since the middle of the last decade. And each one of those provided a good interim low for the market. 4 of them gave us a bounce that was good for maybe 3 to 4 weeks up to test resistance. The other 4 were early stages of the next big legs to the upside. So from where we are right now, from a valuation perspective based upon yield, market's probably capable of pushing back towards, as I say, the best levels we had in the summer. But markets tend to create these big rolling tops, and that's what everything since January of last year has got the appearance of. So if we have a failed high, a failed breakout during September, which would be quite common, the latter part of September into October could see the normal seasonal decline.
Are people still running to so-called safe havens?
Well, during this stability phase, during the panic stage at the early part of August, the gold, silver, bond market really got a strong bid underneath them, and they ran away. They've been consolidating against their 20-day moving averages, which is normal during a pause, and none of them closed below their supports. The catalyst to the upside was the weakness we saw in the equity market. And then as the month progressed, we've seen new highs in gold that pulled back, went up to marginally higher highs again around the 1455-ish range, or 1555. But they did it on lower volumes. And we're seeing excesses there that suggest that we're going to see a turn. And gold actually, I think on the week, is down about $22 off the high. And if we look at the bond market, the relative strength index, if you look at the weekly chart, we've only been this high, 82% on the RSI. We've only been up there 4 times in the whole history of the futures market back to the 1977. And the other 3 examples, market took a rollover here, came back to its 20-week moving average, pretty hard break, before it was able to resume any movement to the upside. So from where we are right now, the safe havens, at least as gold, silver, and bonds, look as though they're ready for a breather. The utilities and the REITs, which have also gained good support during this safe haven move, they could come off a little bit as well, but I think that those trends are still pretty much in place on the upside.
Ross, crude oil still just churning its wheels?
Just thrashing here in this tight trading range. The middle of the week had not a bad bounce, but progressively here, if you look at each bounce starting from the April high, has been progressively lower. It was 61, then 60, 58, and then this week only got up to about 56.5. So there's big overhead selling that's just continuing to push and put a lid on this one for now. The seasonal, as far as the inventories are concerned, would suggest that there's some type of a break just ahead here in the next month or so. But our overall big picture will be that whatever low we're putting in here should be considerably higher 1 year from now.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Danielle Park next on This Week in Money.
Always consult your investment professional before making any investment decision.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, so many people have worshipped at the altar of Warren Buffett, saying Berkshire Hathaway can't do anything wrong. How well have they been doing, say, over the past year and a half?
Well, you see, the wonderful thing about Warren Buffett, and I've read many books on him. I actually wrote about him myself in my first book, because he does pile up cash, which is sacrosanct in the normal fund business, right? He will literally pile up, $1.5 billion or many millions of dollars and just let it sit there, and he'll say, if I can't find anything good to buy, then that's life, right? But that's very uncommon in the mutual fund or management business, where they're typically mandated they have to be invested at all times and never have more than 5% cash. So that's one of the biggest problems with the money management business, is that there's no cyclical buffers built in. Everyone's fully exposed, fully invested through the up cycle and through the down cycle. And then in the full cycle basis, people don't typically get ahead very far. So when it comes to something like Warren Buffett, obviously he's been at it now, for 50 years. I mean, he's 86 years old. So his ability to ride out the down cycles, which there have been many in his career, he continued to just put new cash to work as he went through that. And on a book value basis, he can say, look, the book value of our investments has increased by this amount over the last 40 years. The problem is that no one today actually has 40 years, right? Very few. And certainly not the people who have the bulk of their life savings amassed. As I've mentioned many times, you tend to get that later in life. So people in their 50s, 60s, 70s certainly don't have decades for this all to work out. And so this becomes the problem where Buffett is held up as this oracle who is telling everyone never to panic, never to worry about recessions, that you can always hold shares or always hold his share in particular. He's always talking up the economy and saying that, he thinks it's going to be a great investment. The problem is that in a secular bear market like we've been in since 2000, when valuations began from the highest ever record in human history, you get these recovery cycles that then collapse into bear markets that can last a couple of years where people lose half their money, and then it takes years thereafter to grow it back. And that's exactly what's happened with Berkshire Hathaway shares over the past 20 years, where by the time they had collapsed into the 2008 downturn, it took they basically went down in lockstep with the S&P 500. So there's no protection or defensiveness to be had in holding these shares. Now, even though he had a good cash amount within the fund itself, which he then was able to put to work near the bottom of the cycle and buy things like the pref shares that he got in Goldman Sachs and various preferential instruments that, people generally can't get access to, but because of his position in the industry, he certainly gets preferential treatment or access to some of those things. So in terms of buying out of the bottom, Berkshire can be a great thing to add to your portfolio. However, in terms of holding it at the top, definitely not so much, right? So I had been writing about it, for example, in May of 2018 when they were holding the typical shareholders bazaar, which they hold every year and have this big celebration, and everyone comes and sips cherry cokes with Warren Buffett. But I was pointing out that his preferred valuation indicator, which he's talked about for many, many years, U.S. stocks divided by U.S. GDP, was at the highest that it had been since the tech bubble top in 2018. And so that by his own metric, people should be taking cash out and being defensive and waiting for buying opportunities. But of course, that's not what he tells people to do, because he wants them to stay holding his fund. And so sure enough, since then, over the last 19 months, the S&P 500 is basically flat. The TSX is negative, having had no return since January 2018. And the Berkshire Hathaway Fund, the shares which are traded on the market, which are what people participate, they don't hold the book value of the company, they hold the publicly traded shares. And those shares are now negative, down nearly 5% over the last 19 months. And the point is not that a negative nearly 5% is a big deal. The point is that we haven't even got into the bear market yet, right? We've had a massive topping process in stocks over the last 19 months. And Berkshire shares have moved, actually have underperformed the S&P even by a bit. And they don't pay income, so you're literally just holding on, hoping you can, ride it up, hold on long enough, or not need the money. And the problem is that in this next bear market, it's very likely that we'll see these shares drop by half, along with the major benchmarks, and take several years to recover thereafter. So as I like to say, maybe Mr. Buffett is 86 and a billionaire. Surely he has more money than he could ever use, but most other people are certainly not in that predicament, and they cannot afford to be that lackadaisical or risk exposed during these down cycles.
With these kind of risks, what has that done to pension plans?
Yeah, so this is another prime example of this theory. The theory meets with reality, and it's a very different story. So in theory, these pension plans use these, efficient market hypothesis and all these theses that have been, rolled out as intelligent finance, so to speak. But in reality, those theories have been debunked in real life as being very dangerous to life savings. Because we have short time horizons typically and can't afford to wait 20 years for things to come back around, it's very important to us what happens over 5 and 10 year cycles for the average person. And certainly with pensions, for a long time when you had more young people paying in than old people taking out, you had enough capital going in, you had outperformance in terms of returns in capital markets when bonds were yielding more than 5%. Pensions had buffers built in. They had more capital coming in than going out, and they were making an above average return year over year. But unfortunately, that meant that people then started putting less and less in. And of course, as we get to this demographic shift where we've now got a lot more older people taking out than younger people trying to put in, you have this big gap growing. And that will also get much worse in the next bear market. The pension funds, very like the Berkshire story, they went up with the market cycle into 2008. They collapsed in terms of their values. Endowments, Harvard's fund, everyone that was following these long always thesis about put money in and don't worry about the cycle and just hold for the long term. It all becomes a problem when funding has to come out, when payments have to be made, when people start withdrawing to live or to pay pensions. And suddenly this whole idea of this closed ecosystem where money never comes out and money only goes in and you never pay any fees or any taxes, you never have to take withdrawals, all that drastically undercuts the compounding impact of growth over time of these funds. And so right now, pensions are having to deal with not just low yielding, but literally 16 trillion of negative yielding assets in the world. And of course, what's happened, the demographics were already bad. The pension contributions were insufficient coming into this cycle, and that's just got that much worse as yields have plunged both for equities, which have become insanely valued again, so the yields are very low, and also for the fixed income stuff, which has rallied so much as people desperate for yield were buying up everything. So now we've got this growing gap between the funds in there, the payouts which are accelerating and the amounts that are required liabilities, and the wading into more and more illiquid instruments trying to reach for yield. And so this is likely to cause great mayhem. Because as the bear market kicks in, people want liquidity. They need, not only do they need it for income, do they need to keep taking out the withdrawals, but they also, may lose a job, as I've mentioned before, may lose income in other areas, which make them more vulnerable and need liquidity. And so that's not even talking about the, incredible emotional, psychological havoc it wreaks on people and why they tend to sell at the wrong time. So all of these things are really setting us up for, as I said before, that the answer is not lower rates, which is, they keep cutting rates, which means people have to save more. And we've seen this in the Japanese cycle, Jim. When the Japanese markets topped in 1989, crashed after that, central banks stepped in with all sorts of cutting rates, trying to re-stimulate borrowing and spending, trying to re-stimulate capital investment. Unfortunately, there was so much overinvestment in the prior period that there was no compelling case. And then you have the demographic overlay of the aging population there as well. So what you've seen is you've got a stock market there, the Nikkei, which topped in December of 1989. Today, still like 48% lower than it was at its secular peak. In the meantime, we've had, 8 recessions there in the last decade, averaging a growth rate of less than 1%. So, we know how this book plays out, and the more they try and come up with other ways to cut rates, make debt even more negative yielding, it just means people have to save more, spend less, which slows the economy more, which means they're going to try and do more interventions to try and boost asset prices more. And that's exactly the wrong thing to do. The right thing to do is figure out ways to get people out of debt, work down debt, lower asset prices, lower important things like shelter so that that people can actually afford them and that investors can actually see them on an investment thesis to buy them again instead of a speculation just on a price appreciation story. So all of this is really, in the meantime, what are people doing? Well, they need to try and avoid the stuff that's so overpriced, stay in the stuff that's more safe and liquid, try and work longer. For many people, that's part of the solution here. Instead of trying to retire in their 50s, work longer, save more, keep your risk low, and your liquidity high so that you have an opportunity to buy things when they come on sale. Because I'm quite sure that is going to happen.
We'll have more with Danielle Park when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Danielle Park. Danielle, what about the unsustainable cost of housing? How's that affecting lives?
Well, it's similar. It's the same factor that the debt goosing that's gone on in the last couple of decades that has brought us to this point where we're ridiculously giving away debt to try and get people to, negative yielding. So in other words, people are buying bonds that will pay them back less than they purchased them for, because they just want somewhere to put principal, and have some kind of security or stability of the amount of money, even if it means getting back less than they put in. So it's really turned all the investment ideas completely on their head. The math is completely shot, but moreover, it is having wide social impact. So, I've written and talked about the Australian housing market for some time because it's certainly similar conditions, and more extreme in a couple of regards than what we've seen in the Canadian market. Same sort of story, commodities producers linked to China, in this super cycle that peaked into 2008 and 11. Those economies, Australia and Canada, really benefited greatly from the selling of our rocks and trees to the rest of the world, but we became complacent, that we thought that was going to continue indefinitely, and we didn't sort of manage our income properly, which would have meant paying down debt, making very productive investments, figuring out that a super cycle doesn't last forever, and figuring out ways to diversify the economy. That would have all been what to do in the boom cycle, but instead people doubled down on commodities, just as the price of oil tanked and the whole thing shifted. And at the same time, we've continued on since then as if that was just a blip instead of a secular theme that had changed. And Canadians turned to, borrowing for non-productive investment in their own houses, which is just really an indulgence. It's lovely, but it doesn't produce much in the overall economy. It doesn't make us more efficient, makes us less efficient. Well, the same thing has happened in Australia, of course. And recently, it has become so extreme because the housing market there has also been turning down for the last, about 2 years. And people are now unable to, they had some changes in their lending rules there, which were completely necessary because it was so reckless and crazy. So as they've done that, of course, now it's harder for people to refinance. Rates aren't falling the way they were, so they're not getting this ability to borrow more when the housing prices aren't going up. And so people are really saddled with so much debt, housing that was many multiples of their income and should never have been bought in the first place, but everyone was in a fevered pitch about, thinking housing only went up. And so now it's got so bad that people are having to choose between their mortgage and food. And so many of the major banks are noticing that their defaults are rising. And so what they've figured out is, hey, if we can direct people to food banks, this is true, Jim, I'm not making this up. If we can direct these working people to food banks, they should be able to still eat and pay their mortgage. So it's a way of trying to stem the losses that are coming through the banking system. Those losses are deserved because a lot of money was lent in ways into people that should not have been able to borrow that much, but that's what's happened. So this is nothing to talk about, again, all the mental stress. Nearly half of all homeowners aged 55 to 64 in Australia are now still trying to pay off a mortgage, and that's compared with about 14% 30 years ago. So 14% 30 years ago had a mortgage. Today, about half of them between 55 and 64 still have a mortgage, and that's nothing to do with the younger people, of course, which are all incredibly indebted and stressed out and having a hard time feeding their families. So my point is just, this is another example of this maniacal obsession with how do we force more debt into the system to push asset prices up even higher. You know, you've reached literally a breaking point where what happens is people have to walk away from these houses, and they are, because at the end of the day, you do need to eat, right? You do need shelter, but you don't need shelter that takes every dime that you have so that you can't afford anything else in life. So that's why I say it's a very unsustainable system, and we can't all turn to food banks, which, by the way, only started in the 1960s, and they were meant as a charitable stopgap to people who are having a hard go, you know, had fallen into a period of unemployment, or it was meant as a stopgap measure. But now we're like the banks are directing people there who are working, the working poor, so to speak, and they're poor because their housing is taking a lion's share of their income.
In Vancouver, we've had stories of people pulling up in their Mercedes-Benz to food banks. So it's not just happening in Australia, it's happening here.
Well, it could be. I mean, there's a lot of stories about abuse of food programs, and certainly there's a lot of people that benefit from them. So I'm not one of those people that wants to, you know, shame everyone that's using them as inappropriate or fraudsters. Certainly that is not the case. It's a very small quantity of people that are abusing the system, so to speak. And I'm not even suggesting these homeowners are abusing that system. In effect, they're trying to pay their bills. They're trying to keep their shelter. They just don't have enough income left over for food. So at the very least, this is horrendous financial planning, right? This is very bad. But it has been recommended, endorsed, and perpetrated by policies and advisors within the banking system and within the government and policymakers, right? So this is why people have been really led down a very perilous path, and we're all paying the price because we do need people to have shelter, we do need families to be fed, and the social safety net cannot possibly catch everyone. And, you know, again, with everyone taking out but not enough people putting in, you're just going to have a massive ballooning government debt again, and at some point that too becomes unpayable.
I believe in Britain, if you fall in hard times, the government will pick up your mortgage payment in the theory that it's cheaper to do that than to build social housing.
Well, you know, again, back to quantity, right? In some cases, a modest mortgage certainly may be cheaper than someone renting, and it may be cheaper for the government to assist them with a modest mortgage payment than trying to find social housing for everyone. The problem is, in the math that we're talking about mortgages that are 5, 6, 7, 8 times a person's household income. Then it's also a malinvestment or a bad allocation for government to try and, you know, fund those payments, because the person would be much better off in a rental somewhere that they could actually afford that's maybe, you know, 2 or 3 times their household income, because that's traditionally been what is considered affordable for shelter, is about 3 times your household income. So again, we've got such fat mortgage balances because we had this massive debt inflation of asset prices, which are unsustainable by their very nature and are in the process of coming down. And when they do come down, that will be very, it will be very stressful and financially taxing for the lenders. It'll be financially taxing for the people who are, lose money in this asset deflation, but it will be the answer for how to regroup and recuperate the economy into something that is more sustainable, where people can have shelter, feed their families, save for their children's education, save for their own retirement. We have to be able to afford those other fundamental things. And when you've got these grotesquely inflated property prices, that is a major source of the imbalance and problems that flow from it.
We'll have more with Danielle Park when This Week in Money returns.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Danielle Park. Danielle, are Canadian banks something that you could call a sure bet when it comes to investing?
So Canadian banks are highly cyclical, very, very connected to the credit cycle. So coming out of the bottom of the cycle of a recession, when you've had a major decline in equity markets, the banks typically lose about half their value in those environments, as they did in 2001 to 3, and as they did in 2007 through 8, into early 09. But that is also then a great opportunity typically to add these things to your portfolio for both the dividend stream, which then at that point when you buy them off the bottom of the cycle is typically north of 6 or 7%, which is great income to receive. And then you have a potential for a modest capital gain appreciation, going forward a couple of 3 years, a couple of 3% a year on top of the dividend. So that is the ideal time to add banks, and Canadian banks are not sort of typical of that. The bad time to have banks, and Canadian banks are typical, is near the peak of a cycle, when they're highly valued, when they are fully exposed to a very debt-encumbered business community, as well as a household, when they are heavily levered into the real estate market at the top of a secular climb, when everything begins mean reverting. The banks have the leverage on the way up, which makes their profits grow, which makes them have great free cash flow, but they have the opposite conditions at the peak of a cycle, especially when you've got flat and negative yield curves where they can't make a spread profit, which is the bread and butter of their operations, and then they've got a whole bunch of exposure on their loan book to the defaults, which are already in process. The stats on the number of people filing for bankruptcy, insolvency workarounds, and that sort of thing in Canada has been growing at 10% a month for many months. We're in the expansionary part of that particular default cycle. So now I think is a very dangerous time to be exposed to Canadian banks, but because they are 32 or 3% of the index itself, the Canadian benchmark index in Canada, and that's what most funds and managers replicate, most funds and managers are also heavily exposed to the Canadian banks, and therefore most never want to take money off the table. Again, mandated to be fully invested and mandated to track these benchmarks mindlessly, I call it, because whether they're a good value or not, they're supposed to stay long and wrong into the downturn. So the way that people have to really protect themselves is to not take that bait, and to say, hey, 10-year expansion, record Canadian indebtedness, defaults rising, insolvency filings rising. We're in the down part, the deleveraging part of this cycle. And so the best thing now to do is to stay out of financial, stay out of things that are blindly benchmarked to them, and wait for the bottom in that process, in which case they'll again be valuable things to add to your portfolio.
Mnuchin is looking at 50 and 100-year bonds. What would be the logic behind that? Who expects to be around to collect on a 100-year bond?
Well, unfortunately, there's two things there. One is that there are institutions, as I've mentioned, these critical institutions, pensions, insurance companies, that have to match liabilities, that is, future payments that they are going to be making, and you can tell what that is based on demographic projections. So payments they're going to need to make, they have to match with assets that will be coming due at that time. So from the government's perspective, interest rates, as I mentioned, that the stock markets have been basically flat for 19 months. Not so of bonds, right? Bonds have rallied a lot. They've been a great gainer over that period, as has the U.S. dollar relative to the Canadian dollar. So gains have been made on the currency as well as on things like Canadian bonds. So what that means is that rates are now nearly back to the all-time low we saw in 2016. And so from a borrower's perspective, we're seeing, provinces and municipalities and governments, federal governments, start to say, hey, now would be a great time with rates at the all-time low, the lowest we've seen in several thousand years. Now is a great time to look to raise capital by borrowing money at these really low rates and locking them in essentially for very long periods of time, because they know that once rates ultimately start to rise again, which won't be till we're through the next sort of recession, but once they do start to rise, we should expect them to rise, considerably and over a long period of time. So now's a great time if you're a borrower to be issuing debt to match with, funding needs that you have now and to have a low rate to pay it back over a very long time. The other thing for an investor's perspective is it may seem like an extremely low yield, and it is, but if bonds in North America are going to negative yields like they are in Japan and Europe, then we could make significantly more capital gain on the bonds that we are presently holding, as well as long duration bonds like that may be issued. 100-year bonds is extraordinarily long duration that will be very volatile with every move in interest rates. If interest rates continue to fall for a while, you could get a nice capital gain there. But in a day when interest rates reverse, like for example today, their bonds are selling off again, you're going to get a huge amount of volatility. So for individuals, it's not an instrument that I think is a suitable match for most folks. But for institutions and governments, they aren't going to be as concerned about that. They're just looking to raise cheap funds now, put it in the coffers, because they see the downturn coming and the liabilities growing, and the benefit programs are going to have more and more claims, and they need to have liquidity in the can, so to speak.
Danielle, for people new to you and what you're all about, can you tell us what Venable Park Investment Counsel Incorporated does?
Sure. Well, we've been around, we're in our 16th year managing portfolios for individuals in $1 million or more per household, and we are absolute return, which means we don't benchmark ourselves to the overall stock market like most people do. We don't consider a loss of 10% a good result if the market lost 15. We try to have positive gains every year through the entire market cycle, avoid the losses of the down cycle so we can continue to compound money over time. And that makes us very unique in our approach, and it is ultimately more successful for individuals over time than jumping on the wild ride of the stock market, going up and down, and ending up nowhere. So we have much less volatility and higher compound return over the lifetime of the client.
Danielle, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's president of Venable Park Investment Counsel Incorporated. Her website, jugglingdynamite.com. Coming up, Ed Steer, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ed Steer, founder of EdSteerGoldandSilver.com. He's also director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Merritt, British Columbia. Welcome back to the show, Ed.
Well, thanks for having me on again, Jim.
Ed, what are the seasonalities for gold and silver?
Well, that's kind of an urban legend, and I'll tell you why it is so. I mean, I've seen the charts. Everybody that's involved in the precious metals industry has seen the charts that, it starts slowing down in May or June or whatever, and then it starts picking up in July, August, September. And I suppose there is some truth to that because of, the supply-demand for India and places like that. But the fact of the matter is that, the prices of precious metals have been under the thumb of the bullion banks of the world since back in 1973. So the seasonalities for gold and silver are, to me personally, mean absolutely nothing, because in a rigged market, they can set whatever seasonalities they want. Certainly there is more demand during certain times of the year, but with the prices of both precious metals under the thumbs of the powers that be, the seasonalities, when I look at the charts, I just consider it to be noise.
China has been piling up every piece of gold they can find over the last 5 or 6 years. Is China trying to get to the point where they can base their currency on gold?
Well, there's two questions. I'll answer the first one first. China's been accumulating gold, as everybody knows, for 10, 15 years now. If you look at the Shanghai Gold Exchange and the amount of gold that's going in there and is being reported, they're buying, like you said, up every ounce they can get, not only from their own mine production, but whatever they can buy on the open market as well. And, they're reporting little bits of it every month, dribs and drabs, 3 or 4, 5, 6 tons or whatever they're reporting every month. But the fact of the matter is they have everybody that follows this knows perfectly well that they have many, many thousands of tons that they're holding that they haven't made public yet. So there's no question about it. China is determined to have at least as much gold as the United States, and if they're not there already, they're darn close to it. And they're going to keep this up until such time as we have some sort of monetary reset, which everybody's been talking about for the last 5 or 10 years. And whether or not China is going to go back on the gold standard is highly debatable. If I had to bet my proverbial $10 on it, I'd say no. But what I suspect is that any new world currency we have, whether it be these special drawing rights or whatever you want to call it, will have some sort of gold backing. And as the saying goes, and it still applies to this day, he who has the golden rule, he who has the gold makes the rules.
Do gold and silver look like they're at the beginning of a bull market?
Oh yeah, there's no question about it. Things have dramatically changed in the last 3 or 4 months. And with the values of all currencies being debased into the dirt, with the U.S. dollar about to follow, the rush to hard assets is on, and of course the primary hard assets of choice are gold and silver. And this bull market is just getting underway. I expect that by the end of the year that things are going to be even more positive than they are today. But the bull market is up and running and going strong.
Can gold and silver be in bull markets at the same time as a strong U.S. dollar?
Well, strong is relative, of course. If you take a look at all the fiat currencies in the world right now, it's, as many people say, the cleanest dirty shirt in the laundry basket. And it's only a matter of time, as Mr. Trump has been on Twitter about for 2 or 3 or 4 months now, yelling at Powell to, decrease interest rates and get the dollar down so that American companies can compete abroad. That's a stake in the sand right there. That it doesn't matter what the U.S. dollar does; it's going to be debased. So this strong dollar thing is an illusion. And a year from now, we're going to be looking at interest rates in the U.S. that are going to be zero bound, just like everybody else's.
When you have low or negative interest rates, does that increase interest in precious metals?
It increases anything that has inherent value. I don't care whether it's gold, silver, platinum, palladium, rubber, sugar, cocoa, coffee, crude oil, anything that has physical value as the value of the fiat currencies approach zero. The value of everything else that deemed to have some sort of inherent value increases accordingly. And if you want to take a look at that, everybody is more than familiar with what happened in Zimbabwe, where the currency was debased down to trillions of Zimbabwe dollars per. Everybody's seen the notes or has got one that says 100 trillion Zimbabwe dollars. And it's basically worthless, and people were exchanging it for whatever they could get. So we're at the beginning stages of that in the European and the Western worlds, but with interest rate zero bound, there's no question about it. Any hard asset, as this devaluation of fiat currencies continues, is going to be highly sought after, with, of course, the precious metals being at the very apex of that triangle.
We're hearing gold targets of $3,000, $5,000, $10,000 US per ounce. Bitcoin went to 20 grand. Could gold hit any of those targets?
No, there's no question about it. I mean, it just all depends on what happens with the fiat currencies and the confidence in them. And we just discussed this in previous questions. And anybody who's a keen observer of the financial markets, that's got more than two synapses to rub together, can see where this is headed. And there's no limit on what the price could be, depending on what people perceive the worth of the paper dollars or plastic dollars or digital dollars that they're spending. Take a look at Zimbabwe. I mean, the price of gold, 1 ounce of gold in Zimbabwean dollars was off the charts, okay? So is 10,000 possible? Absolutely. There's no question about it. It just depends on people's faith in the fiat currencies that underlie the financial system we have today, and it ain't looking good.
We'll have more with Ed Steer when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ed Steer. Ed, what are the latest commitment of traders' numbers for gold and silver?
I knew you were going to ask me that question. Well, as you know, we're doing this recording at 12:15 p.m. on Friday afternoon Pacific time, and the next COT report comes out in 15 minutes. But I can tell you what's going to be in it. We're going to have the largest commercial net short position in gold in the history of the COMEX. It is just absolutely off the charts. That's going back to when the COMEX started trading gold futures on January the 1st, 1973. And this exceeds even how high it was back in 2016. It is just going to be absolutely ugly. And silver is better, but it's not going to be that far behind because we had big up weeks last week. And, the commercial traders, the big eight traders, are shorting this market all the way up. And when we see the reports in 15 minutes, they're going to be just absolutely ugly. It's amazing just how desperate the financial system is, the 8 large traders, which are mostly commercial banks and investment houses that have been shorting these things, trying to prevent it the prices from going to the moon. But no, the COT numbers are just ugly.
What's happening in physical versus paper gold and silver?
Well, if you look at what's going on with all the ETFs and mutual funds and the other things that are storing up precious metals, you'll see that the run has been on to physical gold and physical silver now for many, many months. If you look at the 10-year chart, the amount of money that's going into precious metals, regardless of what's going on in the underlying economy, or regardless of what the stock markets are doing, or the currencies, the trend with the big money, the insiders, has been to precious metals now for a very long time, and just in the last 2 or 3 months, that's accelerated at an incredible pace. And there's no question that the run is on into physical commodities already. It's just very quiet. The public doesn't know about it yet, but they'll find out. And by the time they find out, just about every ounce of silver and gold that isn't nailed down is going to be in one of those ETFs or in somebody's personal pocket. So, no, the paper market is basically toast, and the run to physical is on.
How are the HUI and XAU indexes looking?
Well, they're looking fantastic. There's no question about it. You take a look at what's happened year to date. The silver equities have not performed as well as the gold equities. And I think the Huey's up, 40% or something like that year to date. It's some rather very large number. And I don't follow the XEU, so don't know. But the silver equities, I have a chart that I put in my column every day, and they have been really underperforming the gold equities by a substantial margin this year. And that's particularly because J.P. Morgan has been sitting on the price since they bought Bear Stearns out in 2008. And they're desperately trying to keep the price down until such time as they decide to let it go. So the silver equities are underperforming. Most of them are. Some of them are doing very well. And not to drop any names, but I think First Majestic's up like 90% on the year. And one of my other large holdings, Alexco Resources, is up 100% this year. So over 100%. So, there are exceptions to the rule, but everything's going up, but it's just that silver equities aren't going up as fast. But when the silver price is allowed to rise, I can absolutely guarantee the silver equities will vastly outperform their golden brethren.
Are junior gold and silver stocks showing any strength?
Some of them are and some of them aren't. I was looking at my stock list just before you called me, and I'm just going to look at it. Like I mentioned, Alexco, which isn't even a producing mine yet. They've got really good resources in the ground. They're up over 100% in the last 2 months. First Majestic's up 90%. The smaller companies, like I own Bear Creek Mining, is one of my holdings. They've done something, but they're still not that great. And you go down the list, Keith Neumeyer's First Mining Gold Corporation. These are the junior explorer companies. These things are always the last to jump onto the bandwagon in a bull market. So they're not performing. I'm not disappointed they're not performing, but rising tides will lift all boats, and at some point the junior exploration companies are going to go as well. But the junior producers, okay, the ones that, the small companies out there like Endeavor and Exelon and Fortuna and companies such as that, they're just doing phenomenally well this year.
What indicators are you watching for gold and silver?
The Huey. I'm looking at the Huey, and I'm also looking at how much gold and silver is going into all these ETFs and mutual funds. The COMEX stocks, the silver deliveries for September, which started yesterday, which were posted on the Chicago Mercantile Exchange's website last night, show enormous silver deliveries for September. It is just amazing what's happening out there. All the indicators are pointing to the fact that massive accumulation of physical metal is going on across the board. And it's only a matter of time before it's going to be allowed to show in the price. And when it does, it's going to be amazing. There's lots of indicators out there that say this is happening, and if you've got your nose to the grindstone and you got your eyes wide open, they're everywhere.
Where are you investing your own money?
Well, I'll tell you what, 100% of my asset, of every nickel I own, which is a reasonable amount of money, is invested in the precious metals or their equities. 100%. I don't have 1% or even a fraction of 1% in anything else other than the precious metals. So I write my column every day and I put my money where my mouth is.
Ed, what's the latest with the Gold Antitrust Action Committee?
Yeah, I know that Chris Powell and Bill Murphy are at the New Orleans Investment Conference this week, and they both were speakers on the main platform there. And we're still putting out our message, and Chris is writing off to central banks of the world and trying to get the word out. And more and more people, of course, almost the entire investment community, with the odd exception of a few hard-nosed people that are never going to change their spots, now know fully well that the precious metals complex has been rigged for a long time, and GATA is now basically preaching to the choir.
How can people find out more about your newsletter?
They can just Google my name, Ed Steer, S-T-E-E-R, Ed Steer, and my website will pop up, and they can click on the link, and there's a sample column. There's a link on there for the sample column, a tab on there for my sample column, and they can read that column, and that's normally what they would get in my column every day, although the one that's up there on my website is my biggest column of the month. Normally they aren't that long. But if they're interested, the freight is $100 per year for about 260 issues.
Ed, thank you so much for being on This Week in Money.
Hey, I appreciate you having me on, and I hope all your listeners have a great long weekend.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He was speaking to us from Merritt, British Columbia. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park, and Ed Steer. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese President Larry Ray and Aven Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Ray, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's always good to be on the show just before a long weekend.
Larry, we had a news release from the company a couple of days ago. What was in it?
It was the results from our nickel, cobalt, aluminum assay, NCA, for the purity, and because we ran that sample, there was a nice picture of a bulk amount of NCA, which is a beautiful green color, and in our press release. But just to say that we got our battery grade material that was very close to the results second results we received on the nickel manganese cobalt and that the NMC, and that was 99.93. And our result on the nickel cobalt, of course, was aluminum was 99.94. So that was a good increase. That pretty much wraps up the testing that we have to do before we go into the 5th stage. And there'll be more to come on that. And so we're excited about that. That will result in another patent. Which leads me to a couple of questions that were asked over the last few days. And one of them was, how many NDAs have we entered into since we announced we had the 31? Well, we're at 35 now, but we have about, 2 to 3 times that inquiries, and they haven't resulted in an NDA yet because a lot of our stuff is public out there now with the publishing of the first and second patents. So it's not as crucial or critical unless they don't want us talking about them. They don't enter into the NDA until they feel that maybe there's an opportunity there for them. But that is an excellent increase, and for every NDA that we've signed, there's probably 3 that were never signed. So we've talked to a lot of companies, and we've had a lot of meetings. One as recently as last Thursday. And we had we've got good results coming from those. It shows that there's getting to be a larger and more interested group that are interested in our technology. Now, the second question was, can we guarantee our technology? Well, nobody guarantees anything unless they're out of their head. But what we do is we de-risk the project, and this is the pilot plant is a large part of the de-risking. Papering up the patents is another large part of de-risking. And personally, I feel that the company is well diapered or well protected in its patent applications. We'll have a third patent resulting from stage 5, and then I think we've got a pretty bulletproof recycling opportunity out there for everybody. So that's really important. Now, Jim, if you remember, I did a article on the Economic Standard back in June, and just to let you know that we had 82,000 openings on that, which was a record, which also coincided with the breakout of the stock. But we have another article on the Economic Standard, and it's talking about things that I'm quite familiar with, and that is that the U.S. Members of the Democratic-led House of Representatives introduced a bill for a 12.5% royalty on new production from federal lands. Now that is a showstopper as far as I'm concerned. It's when you start putting super royalties out there like that, you're just asking for mining companies to look in other jurisdictions, offshore, in Canada, down south, and it's they're not going to stick around because, to be very honest with you, mining is a perilous industry now. It's really dependent on commodity prices and cooperation with the various parties that are involved. It's become and the onerous studies that have to be done to protect the environment, and feasibility studies that have to meet certain standards and everything else. By the time you get to where you're ready to put a mine into or to build a mine, 5 to 10 years can pass, and and hundreds of and tens, if not hundreds of millions of dollars are spent on these things, which is super risky. And now you put a 12.5% royalty. There's no upside. There's absolutely no upside for any mining company to continue to explore or to develop properties in the U.S. if that was enacted. So, we've seen this we saw this in the super royalties that came into BC back in 1973, where pretty much all of the mining industry that wasn't established in the country, moved elsewhere, and that's where a lot of the money that would have gone into BC ended up in South America and South Africa and various other jurisdictions that didn't benefit the taxpayers here where the money was raised. So and major companies, they pulled the pin. I started up a drill company, and it was a struggle just to pay off all my bills for the next 6 or 7 years, and finally go into the public markets in 1980. But that's something that everybody should be concerned with. I can remember back when the NDP were talking of changing the Mines Act. Nobody would have dreamed at that time that they were going to be so draconian on advancing their agenda for royalties on mine production and killing the industry totally. I mean, that was a total surprise to everybody. So if you look at the article that I've appended, you'll read my thoughts on it at the Economic Standard, and it'll be appended to this podcast. And I hope that the U.S. legislators take notice that that they're really treading on thin ice when it comes to introducing more onerous royalties on mining when they're most of them are having problems making profits or staying ahead of the game. Gold has done well, but the base metals have pretty much been on a slide for the last year, and so you've got a good gold market coming. Let's not kill the gold exploration. you need to get critical metals and rare earths into the domain of the U.S., so you're not dependent on hostile countries for your supply, and you're not going to get that. You're not going to get that increased exposure to exploration and production of these critical metals if you start putting super royalties on them. So that is a concern. I mean, people think, well, that'll never happen. One guy said, well, that'll never happen, and I said, that's what we said in 1972, and it did happen in 1973. So you can't be too careful. And I think that pretty much covers what I wanted to say. With a long weekend coming up, it's a nice period to rest up, recharge your batteries, and get back into the lithium battery space on Tuesday.
Larry, where are you traded, and how can people get more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded on Frankfurt under the symbol 2AM. You can do all kinds of due diligence by going to our website at AmericanManganeseInc.com. And if you really want to talk to somebody on what we're doing, you can always phone the office here at 778-574-4444, or you can email me at lray at LREAUGH@AMYMN.com. And I kind of would just like to remind everybody that we're a critical metals company with some outstanding technologies, and we're in the space that has a big requirement today. So we also hold properties that have critical metals on them, but we hold patents on recycling of lithium-ion batteries, and that's kind of our focus at the time, is the battery opportunity. So I wish everybody a good weekend.
Larry, thanks a lot for the update.
You're welcome.
I've been speaking with Larry Ray, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 30th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, President and CEO of Aven Resources. Welcome back to the show, Jim.
Thank you very much, Jim. Good to be here.
Jim, has it been a busy summer for you in BC's Golden Triangle?
Very busy. As a matter of fact, I just got back from up there. Things are going quite well. We put news out last week, the first 3 holes. To be honest with you, I was only expecting 1 hole, but 3 came back. We've got, I think we're on our 14th hole as we speak right now, and got room for a lot more holes to go. And, the market responded in a kind of negative fashion because we didn't come out of the chute with a, barn burner hole like we did the last 2 seasons. But, that's exploration. Could be our 5th, 6th, 7th, 8th hole. Who knows? But, we're definitely onto something. What we did put out was just basically as we moved around and just slightly south of the main mineralized core of the north boundary zone, we tested a couple of holes. One of those holes was from just the northern part of it that, they all look kind of like bulk tonnage type holes, low grade, fairly reasonably good, intervals. The second hole we reported on, which, would have been hole 50, was, right beside the Noranda, actually and underneath the Noranda hole. And that was, okay. I think we had 50 or 61.7 meters of half gram. So, we're in the neighborhood, basically. If you look at what we had comparable to that last year in that approximate zone, 52 grams of 1.8 and 61 grams of 0.4. So, there is something there. It looks like low grade, but it's associated to that high grade Noranda hole, which was 10 meters of 38 grams. So, we've got more holes coming out in that area. As a matter of fact, we got 5 more holes coming, and in and around and just south of that area. So, it remains to be seen. We are also utilizing a lot of our geophysics this year and looking for more of these conductors that show up. And we're testing some intrusions that are coincidental with the geophysics that we did earlier this year. Because historically, when we look at where we do have these high-grade intersections, especially in the main mineralized core of the North Boundary Zone, they're associated with some of these little fold-shaped intrusions. What we've got going south is some very large intrusions that we want to test, which they're there now testing. Because I think as we get to the south, we're probably getting closer, or more than likely getting closer to whatever's feeding the area, because there's some very large intrusives down there that appear in the geophysics. Plus, what we're seeing is some faults. And if we can find some of these larger faults that come off the Forrest Kerr, and I think we're onto something here.
For people who are looking for more information about the company, where are you traded and under what symbols?
We are traded on the Toronto Venture Exchange, also in the States, on the OTCQB under ABN.V. In Toronto, we're under ABN.V, and Frankfurt, E2L2.
And for people new to Aven Resources, what are you guys all about?
Well, we're all about exploration for gold, and we're here primarily for high-grade gold. We do have some very good high-grade results. We're looking for more of the same, but we're also trying to develop more of a sense of where it's coming from. We're in a very complex area that offers up these really high-grade areas, but you want to try to get into an area that you can predict. You understand the structure, you can see where it's coming from, and you can follow it. And to date, what we've got is some really high-grade areas, like the North Boundary Zone. And, it's a little bit discontinuous. It's a couple hundred meters, but it comes and goes. We're looking for a little more continuity in what we're doing, and I think we're onto something right now. So stay tuned.
Jim, thank you so much for the update.
You bet. Thanks.
I've been speaking with Jim Pettit, CEO and President of Aven Resources. I'm Jim Goddard. Our conversation took place on August 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.